Dividend investing is enormously popular in Canada. The idea of owning stocks that pay you cash every quarter just for holding them has an intuitive appeal that almost every new investor feels at some point. But is dividend investing actually a superior strategy, or is it a mental trick that makes people feel good without producing better outcomes? The honest answer might surprise you. Let's get into it. A dividend is a cash payment that a company makes to its shareholders, typically quarterly. When you own shares of a company or an ETF that holds dividend-paying companies, you receive a proportional payment based on how many shares you hold. Canadian banks, utilities, pipelines, and telecoms are famous for paying reliable dividends. Companies like the Big Five banks, Enbridge, BCE, and Fortis, have paid dividends for decades and are the backbone of many Canadian dividend portfolios. The Canadian dividend tax credit is a genuine advantage for Canadians. Eligible dividends from Canadian corporations are taxed more favorably than regular income. Depending on your province and income level, Canadian dividends can be taxed at a rate significantly lower than employment income or interest income. For investments held in a non-registered account, this is a real and meaningful benefit. Here's where a lot of dividend investors get tripped up by something called the dividend fallacy. When a company pays a dividend, its share price drops by exactly the amount of the dividend on the ex-dividend date. If a stock is worth $50 and pays a $1 dividend, it's worth $49 after the payment. You now have $49 in shares and $1 in cash, exactly what you had before. The total value of your investment hasn't changed. Receiving a dividend is not free money. It's the same as selling a small slice of your investment. The psychological experience is different. Receiving cash feels like income, but the math is identical. This matters because many dividend investors concentrate their portfolios heavily in dividend-paying sectors, like Canadian banks, utilities, and telecoms. That concentration introduces real risk. The Canadian stock market is already heavily weighted toward financials and energy. Owning a dividend-focused portfolio on top of that means you're heavily exposed to a narrow slice of the economy. If Canadian banks have a bad decade, so does your retirement. A globally diversified ETF like XEQT holds over 9,000 companies across dozens of countries and sectors. A concentrated Canadian dividend portfolio might hold 20 to 30 stocks, almost entirely Canadian. The diversification difference is enormous. Dividend investing isn't wrong, it just needs to be understood correctly. For retirees generating income from their portfolio, dividend-paying stocks can be a practical way to fund living expenses without having to sell shares regularly. Receiving quarterly dividend payments that cover part of your monthly budget is a legitimate and psychologically satisfying retirement income strategy, as long as the portfolio remains diversified. The Canadian dividend tax credit makes Canadian dividend-paying stocks particularly attractive in non-registered accounts. As mentioned in a previous video, when deciding what to hold in a non-registered account versus a TFSA or RRSP, Canadian dividend stocks are one of the better choices for the taxable account because of their preferential tax treatment. For long-term wealth building, the evidence strongly favors total return investing, owning a broad, diversified ETF that captures both price appreciation and dividends over a concentrated dividend strategy. You get the dividends and the growth, with far better diversification. The simplest approach, own XEQT or VEQT in your TFSA for long-term growth. If you want dividend exposure in a non-registered account later in life, Canadian dividend ETFs like XDV or VDY are reasonable options, giving you the tax advantage without the concentration risk of picking individual stocks. Here's the takeaway. Dividends are real, and the Canadian dividend tax credit is a genuine advantage, but dividends aren't magic. Chasing high dividend yields at the expense of diversification is a risk most investors don't fully appreciate. For most Canadians, a simple globally diversified ETF captures dividend income alongside growth, with better risk management than a concentrated dividend portfolio. Use the dividend tax credit strategically in non-registered accounts, but don't let the appeal of quarterly cash payments pull you away from a sound overall strategy. Next week, we're covering something almost everyone struggles with: budgeting. Specifically, how to build a budget that actually works without making you feel like you're on a financial diet for the rest of your life. Subscribe, and I'll see you there. See you then.